Welcome back, Alpha Hunters! In this video, I'm going to cover the butterfly order, and we are going to use the option strategy template to help understand how it is put together. And then I will give a breakdown on the order itself. Next, I will give my thoughts on the order. And then lastly, I'll show off some risk profile charts of the butterfly order. So let's use the option strategy template here to help us understand how a butterfly is put together. So we can use a butterfly in two instances. We can use one in the sideways market, or if we expect the stock to go up or down, but we're just maybe unsure. And you will notice for the butterfly sideways order that they have a bull vertical on the bottom is the bottom leg, and then a bear vertical is the top leg. And then you notice also here in the strike column that there's one strike that is common, that is the same. And that is the strike that overlaps. That's the middle strike, okay? I'll go a little bit more into that a little later. But for the butterfly up and down type of order, you swap the bull and bear verticals. So the bull vertical will be on top, and the bear vertical will be on bottom. And so you have many different instances or many different ways you can set up a butterfly order. So if you're wanting a sideways type direction, you are going to want to enter an order with a butterfly with a bull vertical on bottom and a bear vertical on top, okay? And the cash flow is very much going to depend on what kind of verticals we use to set up the trade. The loss for this kind of order setup is going to be anything outside the break-even points. And this is where the break-even is going to be a little different. So if we were paying out in a debit situation, so we will take the outside strikes and we will go to the inside with the premium. And for the credit, we will start with the inside strike and go outwards with the premium. And then the profit is going to be anywhere in between the break-even points. Now for the butterfly, when we want a directional play, when we want the stock to go up or down, we will reverse the roles of the bull and bear verticals. So the bull vertical will be on top and the bear vertical will be on bottom. The cash flow again will depend on which verticals we choose to use in setting up the trade. And the loss is going to be in between the break-even points this time. And then the break-even points, they're going to be a little bit reversed when setting up this trade, as the debit is going to be inside strikes to outside with the premium, and then the credit is going to be outside strikes to inside with the premium. Okay? And then the profit is going to be anywhere outside the break-even points. So if that sounds a little confusing, it's okay. We got some examples coming up that'll hopefully clear up some of your confusion. So some of my thoughts on this order is, first off, obviously you have a lot of choices on how you can set up this trade. But the traditional way to set up a butterfly is to use all calls or all puts. The iron butterfly is when you use a combination of calls and puts. But that's not the common way, that's not the traditional way of setting it up. The traditional way of setting up a butterfly is to use all calls or all puts. And when you use a butterfly, this is going to be a delta or theta type play, where you're wanting the stock to kind of stay within a specific range, and you just want a time to go by. That would be a theta type play, so the sideways movement type setup. Or the delta play is where we want it to go up or down, and we are looking for it to move outside of a range. That would be the bullish or bearish type of situation where you would want to use a butterfly. And that delta play is going to be great for when a stock is unpredictably volatile in those kinds of situations. And I think we kind of all know those ones that get into a nice bullish trend, but you're expecting that pullback. A butterfly can be a really good play on those, because it's like it allows you to keep going on the upside if it keeps going. Or if it does pull back, the butterfly kind of, again, helps out as long as it moves outside that range. But it can also work out really well if a stock is predictably range bound and it's not moving too far high or too far low. The butterfly can be very good on that. And then along with that is it sets up excellent reward to risk to probability of outcome trade scenarios. And that is something that I don't hear a lot of people talk about, is probability of outcome for your reward. And another thing that I have coming in a future video, because that is a very key component to actually being profitable as a trader, is your probability of reward to risk. There are a lot of reward to risk setups out there, but the probability of the outcome of the successfulness of the trade is not actually there. And so that is something I will cover in a future video, but this has excellent reward to risk to probability of outcome setups. And then lastly, this is going to be a great strategy to use often, as long as you understand your expectations and your setups. Like I mentioned earlier, there's many choices to use for this trade setup, so just make sure the expectations of what you are expecting out of the stock and the setup you are using align into the same goal. And if you don't understand the iron butterfly and how to mix the calls and puts, you know what? Don't even worry about it. And I really wasn't even going to cover iron butterflies in this video, but I saw somebody else post a video about iron butterflies. And it's something that they failed to mention about iron butterflies is they're nearly the same reward to risk as normal butterflies. And when I saw them kind of going through to set up an iron butterfly with their broker, you know, they were having to go through and click all the different puts and calls to use. And it just seemed more cumbersome doing it that way than just setting up a butterfly order. There's no need to make things more complicated, right? KISS. There's a reason why the acronym KISS is so powerful. Keep it simple, stupid, and just use calls or puts if that's the best way you understand it. So let's walk through a couple examples real quick to see if we can understand these a little bit better. So we're going to start with a stock of 195, and we're going to use a butterfly and say we want the stock to go up or down. We don't know which way it's going to go. It's kind of just volatile. We just want it to go up or down. And we're going to use strikes of 180, 195, and 210. Now, you have to use a perfectly balanced butterfly like this. You can use a 185 strike, a 195 strike, and a 210 strike, and that is completely fine. It's just called an unbalanced or an ugly butterfly. Either way, it doesn't matter. However you want to set up your reward to risk. But in this scenario, we're going to use a bull put vertical and a bear put vertical. So we're going to stick with just puts for this example. And the 180 strike put is going to be valued at $8. The 195 strike is going to be valued at $13, and the 210 is going to be valued at $24. Now the +1 and -1, that is just to help you understand what is the position impact at that strike. So obviously with the bear put vertical, we would sell the lower leg and buy the higher leg. But with the bull put vertical, we would buy the lower leg and sell the higher leg. So that is how you're setting this up. And if you notice something, there is a 1-2-1 setup here. This is a traditional butterfly, a 1-2-1. And all that means is you have one position at the lower leg, you have two positions at the middle leg, and you have one position at the upper leg. But let's figure out the net premium of this trade. So we will take this bull put vertical and get a credit of 11. We will then take the bear put vertical and get a debit of 5. And then our net premium will be a credit of 6. And then if you remember back to earlier, if we want to go up or down, we will take that premium and use it with the lower strike and the higher strike to get a lower break even of 186 and a higher break even of 204. And then anything outside of those two break even points is going to be profit. Anything within those two break even points is going to be a loss. So let's look at one more quick example and we'll look at some different things here. So we're going to use a butterfly for a sideways stock. So we'll say the stock is trading at 175 and we will use strikes 160, 175, and 190. We are going to use a bear call vertical and a bull put vertical. And if you notice right away, we got a mixture of calls and puts, so this is going to be an iron butterfly. And we'll say the 160 put is valued at 7. The 175 call and put are both valued at 12. And the 190 call is valued at 7. And we can see that we're going to be buying the 190 call. We're going to be selling the call and put at 175. We will then also be buying the 160 put. And if you notice, we have one at 60, and then we have a 1-1 at 175, and then we have a 1 at 90. Now the reason why there's a 1-1 there is two positions, but they're not combined since we're using a call and a put in this instance. Okay, so there's two positions there, but we're actually going to have two different option orders go on at that strike. And then to calculate our net premium, we'll get a credit of 5 for the bear call vertical, and we'll get a credit for 5 for the bull put vertical. And then our net premium for this total trade will be a credit of $10. And then we will use that credit of 10 and the middle strike of 175 to calculate our break-even points of 165 and 185. And then anything within those two break-even points will be our profit. Anything outside of those two break-even points will be our loss. If you appreciated these quick breakdowns, give this video a like and let me know if there's a current stock in the marketplace that you think would be really good for a butterfly order. Okay, so let's look at some risk profile charts. So what you can do if you use thinkorswim or use another broker and you want to set up butterfly orders, so you can right click on the area where you want to set up a butterfly and you come down and buy. Now, the way thinkorswim kind of sets it up is if you buy a butterfly, that is the neutral, like the range bound type of butterfly. You're wanting the stock to stay within that range. You're not wanting it to go outside. Okay? So that is this setup, right? You're selling the two in the middle. That's how you always know if it's range bound or if it's not. If your middle strike has a -2, that's when you know it's range bound. If you want to, let's say, want it to go bullish or bearish, you'd want to sell a butterfly, and that's how you set that up, and you have the +2 then at the middle strike. So I'm going to set this up a little bit different, though. Okay, so I have set these up here in thinkorswim, and what we have done is I've set it up each individual part broken out, just that way I can show off some different examples. But we bought one lower leg here at 465. We're actually going to sell two here at 475 calls. I just have it broken out, that way I can show off iron butterflies as well. So I can actually, if that's a little confusing, I can also do this, and it's the same thing. So we can leave it like that. And then I have bought the upper butterfly at 485. So I got 10-point increments in between the different points. And so that's what we'll look at. So as you can see, it comes to a peak here at the middle strike at 475. And that is our max profit if you are looking to buy a butterfly, okay? And then our losses will be capped at anything outside of 485 and 465, okay? With the break-evens around 467.49 and 482.53, roughly in those areas, okay? So this is a typical butterfly and what you can expect. So as I roll this forward, you will see the purple line as that represents every day going by is what you were wanting is to get it to where it goes to, it just stays in that middle area, right? So that is what you were wanting if you were doing a sideways type butterfly setup. And the way you'll know that is if you sell the two middle strikes, okay? So this is a typical butterfly, and that's what you're wanting out of a typical butterfly. What I'm going to do is I'm going to switch this up, and I'll make this an iron butterfly, and we can check that out real quick. So give me one sec. Okay, so I've gone ahead and set that up. So we have a bull put vertical on our lower part, right? And we have a bear put vertical on our upper part. And what we can do, and what we can see here is if you get confused with the bull, with the butterfly and iron butterfly type strategy. Now this is an iron butterfly setup because we're using calls and puts. So if you get confused with doing a butterfly or an iron butterfly, just remember that, or if you get confused with doing one or the other, just remember, whichever one you're more familiar with, just do that. Because the break-even points, they didn't change. the the risk profile of the trade did not change at all. So if one is a little bit more confusing to you, don't make it complicated. Don't try to be like, oh, I got to do this iron butterfly. Don't worry about it. Just stick with your typical butterfly. Do the 1-2-1 setup, and you'll be okay. It's literally the same thing. In the same situation as you roll forward in time, it looks. I mean, you're still expecting the same kind of thing to happen. Okay, you're just wanting the market, the stock, to stay range bound. If you're having a hard time understanding how this is set up, what I'll do is I'll turn off that the put vertical, and this is a typical bull call vertical, right? That is a typical bull call vertical. And then what you do is when you sell that another middle leg, you have this huge loss area. And so to offset that, that's when you buy the additional leg. So that is just when you are combining both of these verticals, right? So here's the bear put vertical, and then when we add in the bull call vertical, we're just combining at the apex at one common strike here in the middle. So that's the butterfly. So let's swap these around real quick, and let's say we are going to, instead of being range bound, let's say we want it to move outside this particular range. Well, this is what it would look like, right? And we already know that this purple line is going to move down because as we had the peak up and the purple line moved up, this instance it's going to move down, and we want the stock to move outside the range so that we get our max reward. So that's what we are looking for in this scenario. Okay? So that's what you're looking for here. And again, it's nothing that you have to do an iron butterfly. You can do this with a butterfly, and I'll show you a butterfly real quick. Let me set that back up. Okay, so I have gone ahead and set up now another just normal butterfly on calls. So we have one position at the 465 call, we have two here at the 475 call, and then we have one here at the 480 call, which we are selling the first one, we are buying two in the middle, and we are selling the higher leg. So we are selling this lower leg at 465, we're buying two here at 475, and then we are selling the 485. Okay, so this is how you would set this up. So there is no difference between doing an iron butterfly in this situation or doing just normal butterfly. The risk to reward is still nearly the same, nearly identical. It might be a few cents. The market is just a little different, that kind of thing. So, but it's not going to be anything where it's mind blowing. You have to do iron butterflies. That's where the best risk to reward is. It's nothing like that. So don't worry about doing iron butterflies. If you understand butterflies and you really like the idea of setting up a trade using a butterfly, do it. Like, don't run from it. Don't be like, oh man, I don't understand iron butterflies. Just stick with iron butterflies. Keep it simple, and it's fine, and you'll be okay trading. If you want a little bit better breakdown on vertical options, click the video in the top left. Alrighty, take care, Alpha Hunters.